Hi, everyone. We're going to talk through personal holding company tax rules for, I would say, a few minutes, but you know how time goes on when I talk. So, personal holding company tax was something that Congress initiated years ago in order to prevent certain types of corporations, and it would only have to be a closely held corporation, as we'll discuss in a minute, from sheltering income, passive income, from what used to be higher individual tax rates. And what they do is if you actually meet two conditions that we will discuss, then you are considered to be a personal holding company. And if you're a personal holding company, then there are a bunch of mechanical calculations that have to be done to see whether you're subject to PHC tax. And if you are subject to PHC tax, then you are taxed at a rate of 20% on your resulting taxable PHC income, and that is in addition to the regular tax that you would be taxed on your corporate tax return. So let's go, and there is a mistake actually in the book. I was reading up on the history of the PHC tax yesterday and this morning, and on your first page and I'm not going to read to you the page number because it'll be different in your book, right? But on your first page where it's headed up personal holding company tax under objective 2, it says there that the significance of the PHC tax has been diminished since Congress reduced the PHC tax rate 20% in 2016 to match the top tax rate on qualified dividends. That's true, that sentence. Prior to the reduction, the PHC tax rate was the same rate as the top corporate tax rate, for example, 35%. And that is actually not true. And if I take you to the 2010, I pulled the 2000, way I figured this out is I was reading up, I went on the internet and pulled an article on how to avoid PHC tax. And it's written by this guy, I don't know who he is, right? So I checked what he was saying here. And he was saying that from 2003 to 2012, the tax rate was 15% for PHC tax, and that in 2013 it was changed to 20%. And indeed it is 20% now, but what he's saying is actually true, and I proved that by pulling a 2010 Schedule PH, which is the form that you would attach to an 1120 of a PHC company, and this is where you calculate the PHC tax. And if you look at the bottom of the form, it says enter 15% of the amount on line 13 here and on Schedule J. And you guys might remember that Schedule J of Form 1120 is where all the taxes, less credits and less amounts paid during the year are listed. So, and if we go to an 1120, you can see line 8 is where you would list the PHC tax that would come from Schedule PH Form 1120 that I just had opened. And that tax, as you can see, is in addition to all of the other taxes that you're subject to as a corporation. And a few days ago, I walked you guys through the alternative minimum tax. So if you were subject to alternative minimum tax, you would have your regular tax liability on line 2. You would have your alternative minimum tax liability on line 3. And the sum of that, as we discussed on line 4, is your tentative minimum tax. And then you credit yourself with your business credits and your foreign tax credit on lines 5A through 5E. That'll be your total credits that you'll list on line 6, and then you'll subtract the total credits from your total tax on line 4 to come up with your total income tax, and then income tax liability net of credits. Then on line 8, you'll add to that your PHC tax, your personal holding company tax, and there are other credits against that summation that you would then, like the investment credit and the low income housing credit, then you would net those against your PHC tax plus your income tax to come up with your net tax on line 11. And line 11 tax, total tax, is what gets entered at the bottom of page 1, 1120. And it gets put on line 31 right here. And you can see that this says that it's coming from Schedule J, Part 1, line 11, which we just walked ourselves through. So it's kind of onerous, right? If it turns out that you're a PHC company, and if you are a PHC company, you would go take yourselves through the tests, walk your client's company through the tests, the 2 tests that I'm going to walk you guys through. And if you meet those tests, you're a PHC company and you have to attach Schedule PH. And you would check this box here. Now, you might not be subject to any PHC tax, and we'll talk about the rules about how you calculate that. All of this is very mechanical, but there are lots of little tests that you have to do. And I have had this situation. I've had small, closely held corporations in my past life at an accounting firm, where I had to go through the iterations every year of calculating, is this company this year a PHC company? And if so, are they subject to PHC tax? And there are a bunch of iterations, mechanical calculations that you have to go through to get to that point. So it could take like work papers, a bunch of Excel spreadsheets, right? Okay, so let's go back to the slides here. So what they're saying here is that personal holding companies are less popular now, that dividends are taxable at a lower rate than the highest corporate marginal rate. Now, if I walk you through real quick, just to look, the other thing that I did was I took a look at the difference between the corporate tax rates and the individual tax rates. So these are the graduated rates for individuals. And for 2016, there were 7 brackets: 10%, 15%, 25%, 28%, 33, 35, and 39.6%. And then if we look at the instructions for an 1120, here are the graduated rates for an 1120. So the bottom rate is 15% and the top rate is actually 38%. And that's a surtax. That's considered a surtax. If a corporation has over $18.3 million worth of taxable income, it ends up getting taxed at a flat 35% rate. But other than that, you have these graduated rates. So I don't really agree necessarily with the way they've worded this in the slides, talking about popularity of a PHC company. No one wants to be a PHC company because if you're a PHC company, as I explained, you are going to be subject to 2 taxes on your taxable income as a company. You're going to be taxed an income tax on your total taxable income, which is going to include that PHC income, because PHC income is things like interest and dividends and rent income. That's part of your gross income on page 1 of your 1120. So if we go back to the 1120, page 1, here's total income. This is gross income. Line 11 is gross income. Okay. If you look in section 61 of the Internal Revenue Code, gross income is defined as all of this stuff, which is then covered in different code sections later on in the code. But included in gross income are sales, dividends, interest, rents, royalties, capital gains, and then other income. Well, PHC income is defined as and includes items like dividends, interest, and rents, which are considered to be passive income types of gross income. And those are the types of income, if you have a lot of dividends and interest and rents, then it's, as a corporation, it's likely that you will be considered a personal holding company, and you could be taxed twice. And as we'll walk through, we'll see that the way that you get around having to be taxed as a PHC company is by distributing out some of your earnings. And how do we distribute out earnings of a C corporation? Through a dividend distribution to the shareholders. So once you do that, it reduces the likelihood of you being taxed as a PHC company. And that's the whole purpose of PHC tax, is to prevent closely held corps from trying to shelter their passive income by just not distributing it out. So as long as they do distribute it out, then they're not going to be subject to PHC tax likely. Okay, and there are other ways to get out of it too, as we'll talk about. So there are two tests that you go through to determine whether you're a personal holding company. And the first test is the stock ownership requirement. If 50%, or if more than 50% of the value of your outstanding stock of the corporation is directly or indirectly owned by 5 or less individuals, then you have met the stock ownership requirement, which is one fork of the 2 forks in determining personal holding company status. So one thing to be careful here with the stock ownership requirement test is that, and we talked about attribution rules a couple of chapters ago. Attribution rules come into play here. So if your wife if you own 10% of the company and your wife owns 10% of the company, you are deemed to own 20% of the company because you and your wife are attributed to be one person. And this can hurt you, right, when you're determining this 5 or fewer individuals rule in determining PHC status, because you and your wife will not be counted as 2 people, you'll be counted as 1 person. So you don't get to, what you want to do is fail this test, because if you fail this test, it doesn't matter whether you meet the passive income test. So if you fail the 5 or fewer individuals owning more than 50% test, then you fail the whole PHC test and you won't be a PHC. So one way to get out of PHC status is by trying to fail the ownership test by increasing the number of individuals owning the corporation over 5. And the way that you could do that maybe is by, you still keep the ownership in the family, but you keep it in a far-reaching family situation. So instead of you and your wife owning 20% together, you might gift 10% of the stock over to your wife's brother's spouse, which is not, it's still family. And if you were in a situation where you're all trusting of each other, you're saying, okay, we're still keeping the corporation in the family, but now that wife's sister's, your wife's sister's spouse is not considered, is not attributed, the stock ownership is not attributed to him. So now he's considered another person, and he might throw you over the 5 or fewer requirement, and now you'll have 6 individuals owning the corporation, and you would fail this test, and then you would not be considered a PHC. Remember, we don't want to be a PHC because we get taxed extra as a corporation. So just remember, you have to apply the attribution rules. The second test is the passive income test. And this is where at least 60% of your adjusted ordinary gross income is PHC income. And then you're like, well, what's AOGI and what's PHC income? I have no idea. Well, the book walks you through what the definition of AOGI is. And it's actually on the 3rd page of your book. There's figure C5-1, determining, it's one of those tables, determining adjusted ordinary gross income. And you start with gross income, which is reported on your 1120. And that's what I pointed out to you a few minutes ago. You would start with line 11, gross income, and you would subtract from that any gains on the sale of capital assets. So you would subtract line 8 if you have capital gain net income. If this is a plus, a capital gain on line 8, you subtract that from line 11, gross income, and you also subtract gains on the sale of 1231 property. So line 9 is where you list gains from 1231 property, and if you have anything on that line that's a gain, you would subtract that from line 11 too. And then you also subtract from, and that gives you OGI, ordinary gross income. It's just a definitional, it's defined that way in section 543. So, and 542 and 543 are the code sections that you look at for PHC rules in the code. Then you subtract from OGI certain expenses, and those kinds of expenses that you're deducting are expenses related to rent income or royalties, interest earned on certain U.S. obligations held to say, this is all definitional, right? So you just go in the table and read this. These are the things that you would subtract from your OGI to come up with adjusted OGI, which is AOGI. Okay, so then once you would do that calculation, you have that in your pocket. Then next, what you need to do is, and they discuss a little bit in the book about the kinds of rental income and expenses that count that in this reduction, and the kinds of deductions that you would reduce from OGI for rent would be depreciation, property taxes, interest, and rental payments. So, and those amounts in total they also have a name. They're called adjusted income from rents. So it's very definitional and mechanical. You just need to know what's included and what's excluded to come up with your calculation of AOGI. So once you calculate AOGI, then you calculate PHC income. So once you calculate PHC income, and I think, so here's on the slides, it actually walks you through. This is the same as the table I just walked you through in your book. And then the next thing in the slides is where you're looking at all of the parts and pieces, the components of PHC income. So PHC income includes dividends, interest income, annuity proceeds, royalty income, and distributions from an estate or trust. So that, again, is definitional. Now, if you're if you're excluding anything from AOGI that you would normally include in PHC income, then you also exclude it from PHC income. And it talks about this in the book. And one of the examples is interest income. So I told you from our discussion of AOGI a minute ago that one thing that you subtract out from OGI is interest earned on certain U.S. obligations, and also interest on awards, judgments, or tax refunds. So if you exclude that from AOGI, you also exclude that interest income from your PHC income calculation. And then it talks about what kinds of royalties to include, what the definition of annuity proceeds is, etc. So then once you calculate your PHCI, then you go through and here's in your slides, this talks about different things that are excluded from PHC income that you might think would be included if you were just to look topically at the word royalties, but you can see there's certain kinds of royalties that are not included in PHCI. There are certain kinds of rents that are not included in PHCI. So what else do I want to say here? Now, there is a situation where you would exclude from PHCI, personal holding company income, which is an important thing that we have to calculate, because once we get done calculating PHCI, we have to basically take PHCI over AOGI and see if it equals 60% or more. And if it does, then we meet that 5 or fewer individuals owning the corporation, owning 50% or more of the corporation test, then we're a PHC, right? So when we're calculating PHCI, I told you a minute ago that rental income is included, but there's actually a situation where you would exclude your rental income. And that's in a situation where essentially you're a corporation that has most of its gross income comprised of rental income and very little other non-rental income. And the reason they'd let you then, and it's mechanical, the way that you calculate whether you get to exclude your rents. So if your adjusted income from rents is at least 50% of AOGI and your dividend paid deduction, so if you have a dividend paid deduction, equals or exceeds the amount by which your non-rental PHCI exceeds 10% of OGI, then you get to exclude your rent income. And the reason they're doing this is because they don't want to tax a corporation that is basically in the business of renting property. That's not really passive income to them anymore. And that kind of extends out to the definition of passive income rules in section 469 of the code, which affects individuals. So if you're, let me give you an example. I just finished doing my own tax return, and I have a rental property that I rent out. It's a condo. And I rent it out and I receive income and I have expenses that I get to deduct against that, and all of that goes on a Schedule E, right, in my 1040. But every year since I've been renting that property, I have a net loss, a net rental loss on Schedule E showing. And that's a good thing. I like that. And the reason that is because I actually, I'm now sheltering my rent income. But I wasn't I'm actually charging enough rent to cover all of my cash expenses that I lay out. All of my outlay, my expense outlay that goes against that rental property, like mortgage interest, property taxes, insurance, homeowners dues, all of that stuff, if you add up all those expenses for the year and divide by 12, I'm basically getting enough rent to cover those, my cash expenses. But I'm not getting enough rent to cover my non-cash outlay expense. And what is that? That's my depreciation. So I end up essentially with a net loss on my rentals every year. And am I allowed to deduct that from my wage income or my 1099 income? And the answer is no. And the reason why is because I failed the material participation, the active participation test. I am not in the business of renting property. And in order to be in the business of renting property, I would have to meet the hours test that's in the code that basically says I spend the majority of my hours every year renting property. And I fail that because I don't spend that long at all on the rental of my property. So that's passive to me. But if I was a corporation, and I was in the business of renting property and that's all I did, then I would not be considered a PHC because I would fail the PHC income test, even though I would meet the closely held corporation test, because who owns my corporation? Me, myself, and I. So fewer than five or fewer individuals would be owning greater than 50% of my corp, and that would be me. But I would fail the PHC income test because most of my rents, or in my case, all of my gross income would be from rent income. Okay? So that's why you get to exclude the rents from your PHCI income if you meet this AIR rule, which you'll have to go through in your book. It's a test that you have to go through. And I know it was a mouthful when I said what the test was a few minutes ago. It was a mouthful for me to even say, let alone for you to do. But it really is mechanical. And they walk you through how you do the mechanical tests in a couple of examples in your book. So definitely go through those examples so that you'll understand how to calculate it. All right. So, okay, I got interrupted for a minute there. I think where I was planning on going next was talking you through how to calculate the personal holding company tax. So if you fail, or if you meet rather, the two requirements for being a PHC, in that 5 or fewer shareholders, or individuals rather, directly or indirectly own more than 50% of the corporation, and you have passive income that's in excess of 60% of your AOGI, then you're going to be a PHC. And if you are, then the next step is to calculate your PHC tax. And that's where you will actually go to Form PHC. If I could get I had the 10,010 one open, I can close that. So here's the most recent Schedule PH. This is the one that you would attach to a 2016 return. And where did I find this, you guys? I found this on the website, right? And I just typed in PH, just to walk you through this again, if you guys haven't been in lately. Here's the home page. When I first type in www.irs.gov, it takes me into this page. And I clicked on Forms and Pubs, And then I clicked on list of current forms and pubs. And when I did that, I get this box that comes up, this search box, search page. And first Bonnie actually typed in PHC, and I got oh yeah, that didn't work. So then I typed in just PH, because I remembered then that the schedule is not called Schedule PHC, it's called Schedule PH. And that's where I got up both the form, both the Schedule PH and the instructions for the Schedule PH. Now, if we were to go into the instructions, it's going to walk us through in detail all of the rules for calculating PHC tax that are discussed in your book. So, good place to always go, as I'm always urging you guys, right? Look in the instructions, because it will talk in, I think, layman's terms, not in really difficult terms, but in layman's terms, how to calculate things. So that's where you would want to go. So now I'm back on the form here, and I'm a PHC now. I know I'm a PHC because I met those two tests, the ownership test and the PHC test, the passive income test. And because I'm a PHC, I have to fill out Schedule PH. And the first thing that I do is I calculate what's called undistributed personal holding company income. UPHCI. And to do so, you start with your line 28 taxable income before NOL and special deductions. And the reason you start before on line 28 instead of line 30, because as you'll read in your book, and actually if you look on figure C5-2, calculating the personal holding company tax, it walks you through this slide here. It looks just like this slide, in fact. And you'll notice that they start with here on this slide with regular taxable income on line 30 of your tax return. And how do I know that it's line 30? Is because then they're having you add back the dividend received deduction and the NOL deduction. Okay, let's go back to the Form 1120 so you can see what's happening here. So if I go back to Form 1120, line 28 taxable income is before NOL and special deductions. And what are special deductions? Well, your special deduction is defined as your dividend received deduction, because you can see it's coming from Schedule C, line 20. Well, where's Schedule C, line 20? Here's Schedule C. Schedule C is your schedule where you list all of your dividends received during the year. And this line down here, line 19, total dividends, this is going to tie, you're going to bring that total up to line 4 of page 1 of your 1120. So your total dividend income is going to come from Schedule C, line 19. And then if we go back to Schedule C, you'll see that in the first column is where you list the dividends received. And in the last column, column C, that's where you list your special deduction that you get on dividends received. And there's several different deductions that you get on dividends received. Now, if you have a dividend that's received from a less than, and you guys remember this probably from a prior chapter that we already went over, dividends received from less than 20% owned domestic corps receives a 70% dividend received deduction. So when you get done listing all of these dividend received deductions, it totals down on line 20, and that total on line 20 gets transferred to line 29B of page 1120, and that goes right here. So your NOL deduction and your dividend received deduction get summed up on line 29C, and they get deducted, subtracted from line 28 taxable income before NOL and special deductions to come down to line 30 taxable income after NOL and after DRD. So in your book, they actually in that figure in the book, and which looks just like this in the slides, this regular taxable income figure at the top is actually line 30 instead of line 28. Okay, but when you're in the actual form, Schedule PH form, it has you start with line 28 so that you don't have to subtract out the NOL and special deduction, right? So you're saving a step here. And then you also have to add back your contributions that you deducted because they're not allowable in figuring undistributed personal holding company income. And you also have to add back certain excess expenses and depreciation that you took. And then you total, and it'll explain in the instructions how to do that. And it might talk about it in the instructions a little bit too. Negative, positive adjustments. It really kind of glosses over it actually. It really doesn't go over it, but if you look in the instructions, it'll explain what line 3 is. And then what you get to reduce UPHCI by are the amounts on lines 5 through 9. So you get to reduce your UPHCI by your federal tax paid, also by contributions that are deductible under 545B2. So it says see instructions for limitations. So even though you add back your contributions that you took in coming up with your taxable income, you might get to take some of these down below. And then you also get to subtract out your NOL for the preceding tax year that was deductible under 545B4. And you also get to reduce your UPHCI by your net capital gains from Schedule D. Remember, we also reduce capital gains from AOGI in our calculation of AOGI, and we also do not include capital gains in our PHC income calc. So capital gains, as long as they're long-term capital gains, are excluded. We also, and this is the big one, on line 9, we get to reduce our UPHCI by any dividends that are paid, other than dividends paid after the end of the year. And that actually gets calculated in Part 5 of the schedule. Oh, did I say Part 5? Part 6 of the schedule. I thought maybe I found a mistake on the form. It's happened before. And you will notice here that the deduction you're getting for dividends paid are not just for dividends actually paid, but also for consent dividends. Now, what a consent dividend is, and I've seen this a lot, is it's a dividend that is hypothetically going to deem to be paid to the shareholders on the last day of the corporation's tax year, but it's not actually paid. And the reason it might not actually be paid is because the corporation may not have the funds to pay it. But they don't want to get dinged by having to pay a PHC tax, which just makes them in worse shape. Now, not only do they not have the cash to pay dividends to their shareholders, but now they're going to get assessed an extra tax at the corporate level. So to negate that from happening, from them being subjected to a PHC tax, they can consent to a hypothetical dividend to be paid to the shareholders. And what happens is the shareholders are deemed to have received the dividend in their income on the last day of that year. So they will include it on their individual tax return as dividend income, even though they never got the cash. And then they also get basis for that. So they get to increase their basis in the corporation that they own stock in. And then on the corporate side, for the corporation, it gets to reduce its UPHCI by this consent dividend. So you can see how if you made the consent dividend equal to the UPHCI figure before consent dividend, then you would have 0 UPHCI after reducing it for this consent dividend, and then you wouldn't be subject to PHC tax. So this is a planning tool, a planning mechanism for reducing your UPHCI so that you don't have to pay PHC tax. And so you would go through and add up all of this here, and this becomes your line 5 is your deduction, total deduction for dividends paid, and you transfer that back to page 1, line 9. And then you would total the total deductions, and you subtract those from the total on line 4, and the figure, and then you would subtract from that any dividends paid after the end of the year, but not more than the smaller of line 11 or 20% of part 6, line 1, right? So, oh my gosh, so it's another mechanic that you got to go through to figure out what you're going to put on line 12, but you do go through those mechanics because you might end up with another reduction to your UPHCI income. Now, the importance of everything on lines 1 through 12 is that line 13 is your UPHCI figure, and that's what gets multiplied times 20% to come up with your tax. So you can see here it says multiply the amount on line 13, which is UPHCI, times 20% and enter the result here and on Schedule J, line 8. And we already talked about Schedule J, line 8. That's on the 1120, page 3 is Schedule J. This is where all the taxes get entered. And you would put your PHC tax that you transferred over from Schedule PH right here. So, and by the way, you also use this schedule to calculate your PHC income. So they want you to list your PHC income here. And get out of there. I was out of there before, but and here's your stock ownership requirement that you're going to enter here, because they actually want you to prove on this Schedule PH that you are actually a PHC. So what I don't see here is they're not actually having you enter your AOGI. But it does say see instructions here. So it might be that you just don't enter this. I don't normally fill this form out at all unless I already have done the 2 tests, the passive income test and the ownership test. And that's when then I would fill out this form and attach it to the 1120. So I think this is just additional info that the IRS wants to have so that they can see the components of your PHC income that's throwing you into PHC status. And they also want to see what your stock ownership is so they can make sure that, in fact, you meet that ownership test. So that's about it for this is for the calculation of PHC. This is a slide that just pictorially shows you ways that you can avoid PHC designation. And it all has to do with dividends. So, because dividends are subtracted from your UPHCI, and UPHCI is the result that you then multiply times the 20% rate to come up with your PHC tax. You can also avoid remember that AOGI is your denominator, and PHC income, PHCI, is your numerator. And if that fraction is 60% or more, you've met the passive income test. And if you've already met the ownership test, then you would be a PHC. So one way to not be considered a PHC is by failing the 60% fraction test, the passive income test. And so there are two ways you could fail it. One is by making your denominator high enough that it throws you below 60% as a fraction. And the other way is to decrease your numerator. So a planning mechanism for increasing your denominator would be to actually accelerate some sales into the current year, sales of, like, let's say you are selling products, but then you also have some passive income that's being reflected in your gross income. If you can increase your sales, then you're increasing your AOGI, which is your denominator, and that would perhaps throw you below the 60% fraction, which means that you would fail the passive income test, and then you wouldn't be considered a PHC. So it talks a little bit about that. In the book. There's some tax strategy tips, but it also talks about it in this article that I wrote, that I picked up from, I didn't write this, that I picked up from the internet. I would just, I think I've urged you guys this before, be careful when you're picking stuff up off of the internet, and look at the source of it. I don't know who Hensler is, but if I picked something up from a firm like a Big Four firm, or maybe a smaller regional firm that I've heard of, and it's written by a reputable partner or other member of that firm, then I can rely on it more. But this article, actually, I went through and looked at it topically. It looks like it's pretty reliable. But again, so two things. You can go on the internet to do research, but just make sure what you're picking up off of the internet is reliable before you start relying on it. Okay, I hope that helps you guys, and let me just make sure there was nothing. Yep, now we're on accumulated earnings tax. So I will talk to you guys soon. Have a great weekend.